So we'll be starting with chapter 9 of financial literacy, which is investment planning and management. Now, first, there are learning outcomes written, which are after studying this chapter, you should be able to understand the process and objective of investment. Number then explain the concept and measurement of return and risk. Then next is introduction to portfolio risk and return, and the next is diversification and portfolio formation. Now we'll start with the very first topic, which is 9.1 Introduction. Investments play a significant role in your ability to accumulate and preserve wealth. However, it's crucial to realize from the start that no single investment is suitable for everyone. You have unique financial needs, goals, and a nest egg for retirement. Actually, the term investment means different things to different people. That is, while millions regularly invest in securities like stocks, bonds, and mutual funds, others speculate in commodities or options. Investing is generally considered to take a long term perspective and is viewed as a process of purchasing securities wherein stability of value and level of return are somewhat predictable personal circumstances that determine which specific investments are appropriate for your individual situation. We invest today to have more tomorrow. Investment is simply deferred consumption. By foregoing consumption today and investing the savings, investors expect to increase their future consumption possibilities by increasing their wealth. We choose to wait because we want more to spend later. Investment is an instrument that promises some certain or uncertain returns in the future. Moving on to the next page, there is a box with the heading Why Invest? So there are 4 points under it. Number 1, invest so that your money will grow because of compound interest. Number 2, if you keep your money with yourself, you risk losing purchasing power to inflation. Number 3, investing helps you achieve your financial goals. And number 4, invest so that you don't have to rely on anyone. Moving on to the next topic, which is 9.2, investing goals. What you want from your investments depends on who you are. Your investment goals will be different from those of other people and they will change as you go through life. Usually, you have a variety of goals at the same time. You may be looking for long term growth in value but also want a secure and flexible fund for emergencies. Each household will have a variety of objectives and will need different investment strategy for each one. If your goal is to make as much money as you can, you have to be ready to take some risk. You are likely to choose shares in companies with the potential for growing rapidly. So that was point number 1. And the point number 2 is if your goal is to keep your money safe or to provide money to live on, you would choose different investments, such as guaranteed investments or bonds that pay a low but reliable return. Now, one easy way to see how personal factors affect investment choices is to think about your stage in life or the phase of your life that you are in. Stage 1. If you're young, you may be willing to take more risk because you're planning for the long term. If the value of your investment goes down, you'll have the time to recover and your investments can grow over a long period of time. Stage 2. If you're starting a new family, you want to provide security. You may still be planning for the long term, but you need to keep at least part of your money available to provide for shorter term savings goals and emergencies or to make major purchases such as a family home. Stage 3. If your family is becoming more independent, you may have less need for short term savings and be able to save more for your retirement. You may be at the peak of your earning years with cash available for investments, but unwilling to invest your money in anything risky. And stage 4, once you have retired, you may be relying on your investments to provide a regular, reliable income to add to benefits such as your public or private pensions. Moving on to the next topic, which is 9.3 Key Factors in Investment. You need to know at least 3 key factors about every investment: its return, the risk, and liquidity. Number 1, return is the profit that an investor makes on an investment. It can come in 2 different forms, as income or as capital gain. Number 2, risk means uncertainty. You're not sure whether your investments will give high returns or you will lose your money. Risk and return go hand in hand, which means that to get higher return on investments, you will be exposed to more risk. And number 3, liquidity is the ability to cash in or sell an investment quickly at or near the current market price. It affects the value of an investment. Listed stocks and government bonds are liquid because you can usually sell them easily. Moving on to next topic, which is 9.4 objectives of sound investment. There are several features for which the investor should look into an investment. It must be noted that these features must be consistent with the objectives of the investors. Following are some of the objectives which should be kept into consideration while investing. Some of these objectives are discussed here. Number 1, regular return. One of the main objectives of investment is to earn the highest possible return for a given level of risk. Some individuals invest in generating a second source of income. Consequently, they invest in products that offer returns regularly, like bank fixed deposits, corporate and government bonds, etc. An investment is considered a good investment if it offers stable returns to the investors. Number 2, growth. Growth is also an important objective for many investors. A majority of them invest to receive capital gains, which means that they want the invested amount to grow over a period of time. Several options in the market offer these benefits to the investor. These include stocks, mutual funds, gold, property, commodities, etc. Number 3, liquidity. Many investment options are not liquid. This means they cannot be sold and converted into cash instantly. However, some prefer investing in options that can be used during emergencies. Such liquid instruments include stock, money market instruments, and exchange traded funds. Number 4, tax exemption. Some people invest their money in various financial products solely to reduce their tax liability. Some products offer tax exemptions while many offer tax benefits on long term profits. Tax benefits are of the following three kinds. Initial tax benefit. An initial tax benefit refers to the tax relief enjoyed when making the investment. For example, when you deposit in a public provident fund account, you will get a tax benefit under Section 80C of the Income Tax Act. Now, the last, safety of principle. While no investment option is entirely safe, some products are preferred by investors who are risk averse. Some people invest intending to keep their money safe irrespective of the rate of return they receive on their capital. Moving on to the next topic, 9.5 concept of return. Return is the primary motivating force and the principal reward in the investment decision process. In simple words, return is the benefit or gain to an investor resulting from investment process. So the return from an investment is the expected cash inflows in terms of dividend, interest, bonus, capital gains, etc. available to the investor from the investment. There are two types of return. Number 1, realized return, and the next is expected return. Moving on to the next page, realized return. This is the historical return of an investment. Historical return on investment is the annual return on assets over several years, the return which has been earned by investor over the holding period. Expected return. This is the predicted or estimated return and may or may not occur, or we can say that the return that an investor anticipates to earn over some future investment period, say in 1 year. Research analysts and professional investors use historical returns along with the industry and economics data to estimate future rates of return. We can use actual and estimated returns to evaluate various assets such as stocks and bonds and different securities within each asset category. This evaluation process helps you pick the right mix of securities to maximize returns during an investment time horizon. There is a figure given for investment based return. Then we move on to the next next topic, which is 9.6 measurement of return. Holding period return or realized return. The return may be measured as the total gain or loss to the holder over a given period of time and may be defined as a percentage return to the initial amount invested. The return can be measured as follow. Holding period return equals to interest or dividend plus price change in assets over the period divided by purchase price of the asset. Total return is divided into two parts, revenue return and capital return. Revenue return is the essential component of the return. It refers to the periodic cash inflow or income from investment in the form of interest or dividends. Capital return or price changes refers to the difference between the cost price of the investment and the rate at which it can be or is sold. It is the difference between the beginning price and the ending price of the investment. Then expected return, or we can say in brackets ex ante return. The average return based on a series of historical returns may not help make future predictions about expected returns. Therefore, an investor may have several probable returns and assign probabilities to each expected outcome. Security analysts can actually construct a probability distribution of returns by assigning the probabilities to expected return outcomes. So we move on to the next page. Expected returns can be calculated by multiplying the possible outcomes in bracket expectations from the rate of return. then by the chances of them, again bracket, probability of earning the return, bracket close, occurring, and summing the results. Simply, it is the weighted average of the expected return calculated by multiplying the possible return with the respective probability. Moving on to the next topic, 9.7, real rate of return. Real rate of return is the inflation adjusted return. Rate of inflation may also reduce the income earned by an investor, so the prevailing inflation rate should also be considered at the time of making the investment decisions. The relationship between the real rate of return, nominal rate of return, and inflation can be expressed as real rate of return equals to nominal rate of return minus inflation rate upon 1 plus inflation rate. So, for example, assume if the rate of interest is 10% and the rate of inflation is 6%, then the real rate of return would be real rate of return equals to, in brackets, 0.10 minus 0.06, bracket close, divided by, in brackets, 1 plus 0.06, which equals to 0.04 divided by 1.06, which again equals to 0.0377 equals to 3.77%. So if the inflation in the market is 6%, so instead of getting 10% return, you actually got 3.77%. Moving on to the next topic, which is 9.8, impact of taxes on investment decision. So income from investment are also subject to tax. However, the rates of tax differs from investment to investment. Some income from investment are also exempt from tax, such as public provident fund, tax-free bonds, etc. The dividend paid to equity shareholders is subject to tax to shareholders. However, interest in case of most of the investment are taxable in the hand of investors. Similarly, the capital gain may also be required to be classified into short-term and long-term capital gain depending upon the relevant tax provisions. The shareholders are liable to pay long-term capital gain tax on sale of shares at the rate of 10% over and above 1 lakh. The short-term capital gains on sale of shares is also taxed at the rate of 15%. Even now, the sale of mutual fund units are also liable to tax under the short-term and long-term capital gain. An investor need not ignore the tax implication in making investment decisions. An investor must find out the after-tax return on his investment and then his after-tax return be considered for decision making. In order to find out the total return from an investment, the tax implications of capital gains or losses should also be incorporated. As a measure of tax planning, investors can time the sale of investments. The income tax adjusted return may be calculated as follows. Income tax adjusted return, or we can say net return, equals to taxable rate of return divided by coupon rate in bracket 1 minus t, bracket close, where t equals to tax rate. So, for example, if Mr. X is earning 20% interest on bonds and his income is subject to tax at the rate of 30%, the after tax rate of return is, so after tax return in this case would be equal to 0.20 multiplied by in bracket 1 minus 0.30 bracket close equal to 0.14 or 14%. Moving on to the next page. So, in case the investor has been offered both types of options, tax free and taxable, either he can convert the taxable into income, tax adjusted return, or tax free return into tax equivalent return, bracket before tax, in order to have the same ground of comparison. The tax equivalent return equals to tax free return divided by 1 minus tax rate. So, for example, if Mr. A is earning 8% tax-free interest on debenture and his income is subject to tax at the rate of 20%, in this case, the taxable equivalent return is equal to 0.08 divided by 1 minus 0.30, which is again equal to 0.1143, which is again equal to 11.43%. Moving on to the next topic, which is 9.9, risk. Although the return is an essential aspect of determining whether investment is appropriate, it's equally important to consider the risk associated with an investment. Each type of investment offers a different level or type of return. Similarly, each investment has different associated risks. So, uncertainty and risk. So, uncertainty is the core concept of risk. It is often used in connection or interchangeably with the term risk. The meaning of uncertainty refers to a state of mind characterized by doubt due to lack of knowledge about what will or will not happen in the future. In the case of risk, we can assign the probability of happening or not happening of an event based on facts and figures available. Regarding the decision in case of uncertainty, we cannot assign a probability for the happening of events, either the facts or figures are not available. While risk is a state of nature, uncertainty is a state of human mind. Moving on to next topic, 9.10 types of risk. There are two primary types of risk: systematic risk and unsystematic risk. Now, systematic risk is the type of risk that is impossible to avoid altogether. It refers to that portion of the variability in return which is caused by the factors affecting all the firms. Examples of systematic risks include inflation, recessions, interest rate policy of the government, political factors, credit policy, tax reforms, and war. These are the factors which affect almost all firms. Unsystematic risk is the risk that affects an isolated group of companies or industries. This risk represents the fluctuations in returns from investment due to factors which are specific to the particular firms and not the market as a whole. These are the factors which are controllable by the firm. Moving on to the next topic, which is sources of risk. Different sources contribute to variations in return from investment. Each of these sources constitutes an element of risk. The different types of risk in the investment are as follows. So we are moving on to the next page. Number one, business risk. When investing in a company, you may have to accept the possibility that the firm will this firm will fail to maintain sales and profits or even stay in business. Such failure is due either to economic or industry factors, or as it is more often the case, to poor management decisions. Business risk is the uncertainty surrounding the firm's cash flows and subsequent ability to meet operating expenses on time. Number two, financial risk. Financial risk concerns the amount of debt used to finance the firm and the possibility that the firm will not have sufficient cash flows to meet these obligations on time. Look to the company's balance sheet to get a handle on a firm's financial risk. As a rule, companies with little or no long-term debt are relatively low in financial risk. This is particularly so if the company also has a healthy earnings picture. Number three, market risk. Market risk results from behaviors of investors in the security markets that can lead to swings in security prices, or we can say that it is caused due to the herd mentality of investors, that is, the tendency of the investors to follow the direction of market. These price changes can be due to underlying intrinsic factors in changes in political, economic, and social conditions, or investors' taste and preferences. Number four, purchasing power risk. Changes in the general level of prices within economy also produce purchasing power risk. In the periods of rising prices, which is inflation, the purchasing power of the money declines. This means that the same amount of money can buy a smaller quantity of goods and services due to increased prices. Therefore, if investment income does not increase in times of rising inflation, then investor is actually getting lower and lower income in real terms. In general, investments in brackets such as stocks and real estate bracket close, whose values tend to move with the general price levels, are most profitable during periods of rising prices, whereas investments such as bonds that provide fixed returns are preferred during periods of low or declining price levels. Moving on to the next topic, which is types of investors. Based on investor preference or attitude towards risk, there are classified into three groups: risk averse, risk seeker, and risk neutral investors. So first we have risk averse. These investors try to avoid risk. However, they may be ready to take risk if the return available for taking extra risk is commensurate. For every additional unit of risk, they demand higher and higher compensation in terms of higher returns. Some investors are more risk averse investors, also known as conservative investors. Some investors are less risk averse investors, also called aggressive investors. Then risk neutrals. These investors require just a sufficient return for taking the risk. They make their investment decisions purely based on return. They do not consider risk. They want no extra return for a given level of risk. Risk is not an essential factor for these investors. Then risk seekers, they undertake more and more risk even if it is not accompanied by higher returns. They are risk lovers and engage in fair games as well as gambling just for the sake of fun or excitement. Moving on to the next page, risk in different types of investment. Different kinds of investments subject to different kinds of risk. Three major investment classes are cash, bonds, and stocks. The risks that typically affect each are: number one, for cash. The chief risk is purchasing power risk, the risk that the return on investment or value of investment principal as measured by purchasing power will decrease due to inflation. Here's an example. If you invest in a cash investment that pays you 4% while the inflation rate is 3.75%, you'll actually lose purchasing power if your 4% income is subject to tax. Then for bonds, the investment in bonds has two outcomes. Number one, the interest rate will beat inflation. Number two, the interest will be paid and you will get your money back. Consequently, the relevant risk here are interest rate risk in bracket, that is, will interest rates rise, thereby reducing your bonds value, bracket close, and default risk, again in brackets, will the bonds issuer pay you back, and bracket close. Now for shares, the investor invests in shares of a company based on issuing company's performance over time, and the stock's price can be valued based on what the market expects the company to pay each shareholder in the future. That value is based on company's expected profits. If the profits turn out to be lower or higher than expected, you bought the stock for the wrong price. In addition, the stock price may be affected by an economic consideration affecting the company, the industry, region, or the entire stock market. Now there is a picture which is having a risk meter and depicting that. Then we have the next topic, which is 9.14, measurement of total risk. Risk is defined as the variability in expected returns. The variability can be estimated using various statistical methods like range, standard deviation, and variance. We move on to the next page. Number one, range. It is defined as the difference between the highest and lowest possible returns from an investment. More the range, higher will be the variability. Hence, greater will be a risk. Then number two, variance or standard deviation. The square root of the variance is the standard deviation. The standard deviation of securities can be calculated by measuring the extent of deviations of the individual rate of return from the average rate of return. There is a box given which has the heading types of risk, and there is a flowchart being made. So we have a box of systematic risk, which has 2 points under it: uncontrollable by an organization. Number two, macro in nature. And in the next box, which is named for unsystematic risks, again we have 2 points: controllable by an organization, and the next one is micro in nature. Moving on to the next topic, which is 9.15, risk return trade off. The different type of investment have different degrees of risk and the required rate of return. The government securities have a rate of return equal to the risk-free rate. As a result, risk increases, the required rate of return also increases. Equity shares have maximum risk, so the maximum required rate of the return is also highest. The risk-return trade-off means that higher risk is associated with a greater probability of higher return and lower risk with a greater probability of smaller return. This trade-off of an investor faces between the risk and return while considering investment decisions is also called the risk return trade off. Then again, we have a figure named figure 2. Now, moving on to the next page, we have, for example, Rohan faces a risk return trade off while deciding to invest. If he deposits all his money in a savings bank account, he will earn a low return, that is, interest rate paid by the bank. Still, as his money will be insured up to an amount of 1 lakh, currently, currently the Deposit Insurance and Credit Guarantee Corporation in India provides insurance up to 1 lakh, bracket close. However, if he invests in equities, he faces the risk of losing significant part of his capital along with the chance to get much higher return compared to a saving deposit in a bank. On to the next topic, which is 9.16, investment opportunities at financial products in India. Best investment options in India. Number one, equity stocks. Equity is a part of a company, also known as stock or share. When you buy shares of a company, you basically own a part of that company and can expect to profit when the company profits. These shares are traded on stock exchanges, which facilitate the buying and selling of stocks, thus providing a marketplace. Investing in equities is riskier and definitely demands more time than other investments. For beginners, it's better to invest in the share market via mutual funds, which are professionally managed and are less expensive. Buying individual equity stocks of the company listed or unlisted on the stock exchange is known as direct equity investment. You can get capital gains or dividend returns from your direct stock investments. The performance of stock depends on the factors such as market position, company's performance, etc. Now, there are 3 points given. This option is one of the most volatile investments and has a high risk return ratio. Number two, one of the best investment options to generate inflation adjusted wealth. And number three, suitable for a long term horizon. Now, number two, bonds or debentures bonds. Or debentures represents long term debenture instruments. The issuer of a bond promises to pay a stipulated stream of cash flow. This generally comprises of a periodic interest payments over the life of the instrument and principal payment at the time of a redemption. Bonds may be classified into the following categories. Number one, government securities. Debt securities issued by the central government are popularly called GSECs. They may be in the form of treasury bills or dated government securities. Number two, PSU bonds. Public sector undertakings issue debentures that are referred to as PSU bonds. There are two varieties of PSU bonds: taxable bonds and tax-free bonds. While PSUs are free to set the interest rates on taxable bonds, they cannot offer more than a certain interest rate on tax-free bonds, which is fixed by Ministry of Finance. Number three, debentures of private sector companies. These debentures are issued by private sector companies. The obligation of a company towards its debenture holders is similar to that of a borrower who promises to pay interest and principal at specified times. Moving on to the next page. Number three, mutual fund. A mutual fund pools money from many investors, invest in stocks, bonds, short-term money market instruments, other securities or assets, or some combination of these investments. The combined holdings of the mutual fund owns are known as its portfolio. Each unit represents an investor's proportionate ownership of the fund's holdings and the income those holdings generate. Buying a mutual fund unit is simple and easy since these are sold by many banks and the minimum investment amount is small. Before investing, it's important to remember that if an offer is too good to be true, it probably is. Also, be sure that the product or company you are investing in is a registered entity engaged in legitimate business. There are different types of mutual fund in the market. Some examples are: number one, equity mutual funds. The type of mutual funds where the funds are primarily invested in equity stocks are known as equity mutual funds. Equity mutual funds can invest anywhere between 70 to 95% of the fund value in equity stocks and related instruments. Since these are equity based, they offer high risk return ratio. Number two, debt mutual funds or bond funds. We have seen that how investing in equity can give you the best of returns but also possess high risk. What if you do not have a high risk appetite and do not want to take much risk? If that is the case, then you can consider debt mutual funds. Number four, national pension scheme. National pension scheme is an investment designed to help you in your retirement. NPS is backed by the government and is regulated by Pension Fund Regulatory and Development Authority. NPS helps you to have a strong retirement corpus at your disposal. You can use the NPS retirement account as a salaried or self-employed investor. Number five, public provident fund. Public provident fund is one of the most popular and safe investments for your long-term goals. Originally introduced as a safe retirement investment plan for self-employed, the plan has been popular for long-term investors because of number one, tax efficiency. You can claim deduction under Section 80C up to 1.5 lakhs for ULP investments. Also, the maturity value is tax-free. Number two, liquidity. You can borrow from the accumulated corpus within the first 5 years of the account. After 5 years, partial withdrawals are allowed. Risk return mix. Low risk investment with a market linked rate of interest, which is updated every year. Now, and the last one is investment period. Minimum 15 years. After that, you can extend the account in batches of 5 years. Now, number six, we come to deposits. A good portion, and we are also moving on to the next page. And number six is deposits. A good portion of the financial assets of individuals is held in the form of deposits. They can be broadly classified as bank deposits. It is a facility offered by the banks that ensures the safety of your invested money and provides stable returns. In bank fixed deposits, you must invest a lump sum amount with the bank for a specific term at an existing rate. After your term gets over, you will receive your principal with the compound interest added over the term. Post office deposits. Similar to fixed deposits of commercial banks, post office also accepts deposits from the public. There are different types of post office schemes available in which the person can deposit their money. Company fixed deposits. Many companies, large and small, solicit fixed deposits from public. Fixed deposits mobilized by manufacturing companies are regulated by the Company Law Board, and fixed deposits mobilized by finance companies more precisely non-banking finance companies are regulated by the Reserve Bank of India. Now number seven, money market instruments. Debt instruments which have a maturity of less than 1 year at the time of issue are called money market instruments. These instruments are highly liquid and have negligible risk. The major money market instruments are treasury bills, certificates of deposits, commercial papers, repos, etc. Number 8, Senior Citizen Savings Scheme, SCSS. Senior Citizen Savings Scheme or SCSS is an investment option designed for people who are retiring or have retired. It is a government backed investment option where you can invest a lump sum and get a regular income stream. Post retirement, you can open a SCSS account in two ways, via post office or via bank. Now, number 9, real estate investment. Investing in real estate is also a good option. Real estate investment refers to buying properties such as buildings and land. This is one of the best investment options that can combat inflation. Real estate investment can give you a shot at both regular and capital gain income. Then number 10, RBI bonds. RBI bonds are one of the safest investment options in the market. The Reserve Bank of India, that is RBI, issues bonds to the public to raise money for the development of various government projects. These bonds have specific term. After maturity, money is returned along with the interest generated. You can buy RBI bonds from any of the 12 national chains along with 4 private banks. To acknowledge your debt, RBI will issue you a certificate of holding. The certificate will act as a proof during maturity. Number 11, gold. In India, gold is often seen as a go-to investment to keep a family's legacy safe, but rising costs and making charges rates have now made them less attractive. Number 12, financial derivatives. A financial derivatives is an instrument whose value is derived from the value of an underlying asset. It may be viewed as a side bet on the asset. The most important financial derivatives from the point of view of investors are options and futures. Moving on to the next page, number 13, life insurance. In a broad sense, life insurance may be viewed as an investment. Insurance premiums represents the sacrifice in the short sum, the benefit. The important types of insurance policies in India are: number 1, endowment assurance policy; number 2, money back policy; number 3, whole life policy; number 4, term assurance policy. Moving on to the next topic, 9.17, portfolio. A portfolio refers to a collection of investment avenues such as stocks, shares, mutual funds, bonds, cash, and so on, depending on the investor's income, budget, and convenient time frame. In other words, a portfolio is a group of assets or a collection of assets. It is not desirable for any investor to invest all of his funds in one individual security or asset. The investor will invest in different types of securities depending upon their risk return preferences. The portfolio allows diversifying risk. Now, move on to the subtopic, portfolio management. Portfolio management implies tactfully managing an investment portfolio by selecting the best investment mix in the right proportion and continuously shifting them in the portfolio to increase the return on investment and maximize the investor's wealth. So we can say that it is the art of selecting the right investment policy for individuals in terms of minimum risk and maximum return. Portfolio management refers to managing an individual's investment in the form of bonds, shares, cash, mutual funds, etc., so that he earns the maximum profits within the stipulated time frame. It is the process of construction, maintenance, revision, and evaluation of a portfolio. The objective of portfolio management is to build a portfolio which gives a return commensurate with the risk preference of the investor. Portfolio management deals explicitly with the security analysis and selection of portfolio, revision of portfolio, and evaluation of the portfolio. In layman's language, the art of managing an individual's investment is called portfolio management. Now, another subtopic is activities involved in portfolio management. Number 1, selection of securities in which the amount is to be invested. Number 2, creation of an appropriate portfolio with the securities chosen for investment. And number 3, making decisions regarding the proportion of various securities in the portfolio to make it an ideal portfolio for the concerned investor. These activities aim at constructing an optimal portfolio of investment that is compatible with the risk involved in it. Moving on to the next page and the next subtopic, which is process of portfolio management. Number 1 is security analysis. It is the first stage of portfolio creation process, which involves assessing the risk and return factors of individual securities along with their correlation. Number 2, portfolio analysis. After determining the securities for investment and the risk involved, a number of portfolios can be created out of them, which are called feasible portfolios. Number 3, portfolio selection. Out of all the feasible portfolios, the optimal portfolio that matches the risk appetite is selected. Number 4, portfolio revision. Once the optimal portfolio is selected, this portfolio manager keeps a close watch on the portfolio to make sure that it remains optimal in the coming time to earn good returns. The portfolio management services are provided by financial companies, banks, hedge funds, and money managers. The next subtopic, portfolio return. Portfolio return is the weighted average of the returns of the individual assets or securities comprising that portfolio. The weights are the proportions of total funds invested in a particular asset or security. Example 1, Mr. X has rupees 1 lakh for investment. He invested 30% of his funds in securities of X Limited, which are likely to provide a return of 14%, and the remaining in securities Y Limited, which is likely to provide a return of 19%. Find the expected return on total investment. Solution would be this expected return will be found as under absolute return equals to rupees 17,500, percent return equals to 0.175 or 17.5%, which equals to 17,500 divided by 1 lakh into 100, which equals to 17.5%. Now, example 2, investor has a portfolio of fine securities who so example 2, investor has a portfolio of fine securities whose expected returns and amount invested are as follow. So security amount, so security 1 amount is 1,50,000 and expected return is 12%. For security 2, amount is 2,50,000, expected return would be 9%. And then for 3 lakh, expected return 15%. For 1 lakh, expected return 18%. And then for 2 lakh and expected return 14%. Solution: total amount invested would be 10 lakh. Hence, the weight of each security can be calculated as follow. Weight of security equals to amount invested in security 1 divided by total amount invested. So then they have calculated the weight of security, which is for security 1, which comes out to be 0.15, for 2, 0.25, for 3, 0.30, for 4, 0.10, and for 5, 0.20. And then WI into RI for security 1 comes out to be 1.8, for 2, 2.25, for 3, 4.5, for 4, 1.8, and for 5, 2.8. And the expected return of portfolio comes out to be 13.15. The next subtopic is portfolio risk. The risk of a portfolio is measured using the standard deviation of the portfolio. However, the standard deviation of the portfolio will not be simply the weighted average of the standard deviation of the two assets. To find the risk of portfolios, the riskiness of each security vis-a-vis the overall portfolio is to be considered. This can be studied with the help of covariance or correlation between the assets. The covariance reflects the co-movement of the returns of the two assets. Covariance indicates the way the security returns vary with each other and affect the overall risk of the portfolio. If the rate of returns of two securities move together, the covariance is positive. The next subtopic, portfolio diversification. Diversification is a technique of allocating portfolio resources or capital to a mix of different investments. The ultimate goal of diversification is to reduce the portfolio's volatility by offsetting losses in one asset class with gains in another asset class. A phrase commonly associated with diversification is quote, do not put all your eggs in one basket, unquote. Having eggs in multiple baskets mitigates risk. If one basket breaks, not all eggs are lost. In the context of portfolio management may be defined as a risk management technique that makes various investments within a portfolio. Basically, it is a process of minimizing unsystematic risk. It involves the selection of assets in a manner that the total risk may be brought down. It is a risk of allocating capital in a way that reduces the exposure to any one particular asset or risks. Moving on to the next page, diversification theory is based on the premise that the market values of some assets tend to rise and fall together. In contrast, the market values of other assets move in opposite directions. Factors independent of the financial characteristics of a particular investment, such as economic, political, and social events, can affect its value. While portfolio risk cannot be totally eliminated, it can be reduced by constructing a diversified portfolio that contains a mix of asset types whose values have historically moved in opposite directions or the same direction but to a greater or lesser magnitude. The basic idea behind diversification is that excellent performance of some investment avenues balances or outweighs the negative performance of other investment avenues. Therefore, investors should divide his total funds into as many securities or companies as possible and as many industries or economics as possible. Now, there are some practical problems which are given. Question 1 is A part. An investor A purchased a bond at a price of rupees 900 with 100 rupees 100 as coupon payment and added at rupees 1000. What is his holding period return? Then for B part, if the bond is sold for rupees 750 after receiving rupees 100 as coupon payment, then what is the holding period return? Solution. Part A, holding period return equals to interest plus price change over the period divided by price at the beginning equals to that equals to 100 plus in bracket 1000 minus 900 bracket close divided by 900, which is equal to 22.22%. Then for part B, holding period return equals to again interest plus price change over the period divided by price at the beginning, which equals to 100 plus in bracket 750 minus 900 divided by 900 equals to minus 50 upon 900, which is equal to minus 5.5%. Question number 2. If the expected return of equity share is 20.01% and the rate of inflation during the year is 8%, calculate inflation adjusted return. Solution. Inflation adjusted return equals to 1 plus nominal return divided by 1 plus inflation rate minus 1 whole minus 1. Then that equals to 1 plus 0.2001 divided by 1 plus 0.08 whole minus 1. Then that equals to 1.2001 divided by 1.08 minus 1 equals to 0.1112 into 100, which is equal to 11.12%. Moving on to next page. Question number 3. Mr. A is earning 20% interest on bonds and he is paying income tax at the rate of 30%. What will be the effective rate of return on interest income? Solution. Rate of interest equals to 20%, income tax rate equals to 30%, effective rate equals to interest rate into 1 minus tax rate, that is again equal to 0.20 in bracket 1 minus 0.30 equal to 0.20 into 0.7 equals to 0.14 or 14%. Question number 4. Mr. X is interested to earn 12% net return on his investment. If his income is subject to 30% rate of tax, find the tax equivalent rate of return. Solution. Effective rate equals to 2%, tax rate equals to 30%, the tax equivalent rate equals to tax free rate divided by 1 minus tax rate equals to 0.12 divided by 1 minus 0.30, which is equal to 0.1714, that is equal to 17.14%. Then question number 5. Mr. X has two options for investment. Option A offers 25% rate of interest whenever option B offers 18% tax free. If Mr. X's income is subject to income tax rate of 30%, which one option is suitable for investment? Solution. Mr. X should go for option providing higher net rate of return. Calculation of net rate of return in both of these cases. Option A, normal rate of return 25%, income tax rate 30%, effective rate of return equals to effective rate equals to rate of return into 1 minus income tax rate equals to 0.25 into 1 minus 0.30 equal to 0.175 or 17.5%. Option B, 18% tax free return. So Mr. X should opt option B, that provide higher rate of return in comparison to option A. Moving on to, okay, so this is the end of chapter 9.
Chapter 12, Health Insurance. Introduction. When you are healthy or in your younger years, you won't probably feel the need to buy health insurance. But you certainly need to stay prepared for the worst. In our busy lives, there is always a probability of unexpectedly becoming sick or requiring expensive treatments. There is always a slight chance that someone dear to us might be at the mercy of a chronic condition which requires long-term care. What will happen if there's an emergency medical situation and you are not financially adept to meet your medical needs. Obviously, the last thing that you would want to do is wipe off all your savings to meet your medical needs. Fortunately, there's a health insurance. Health insurance ensures that undergoing long-term treatment does not throw a family into dire financial straits. By paying a small amount of premium to the insurer, you can take a cover under a comprehensive health insurance plan. This will shield your savings from sudden shocks of medical treatments. In this way, health insurance acts as a protective cover for both savings and healthcare so that you and your beloved family can continue to enjoy their life. Need of health insurance. Health policies are designed to cover your medical expenses and give you the freedom to avail of quality healthcare. In one of the network hospitals, depending upon the insurance purchase, thus policyholders can access medical treatment of the covered perils without any hassle. The fast The fast-paced life, bad eating habits, high level of pollution, and higher risk of incidence of diseases at a younger age are the major factors that may result in medical emergencies. If you have not covered yourself and your family under a family health insurance plan, a medical emergency can leave you cash strapped. So why wait for an emergency to occur when you can keep yourself protected with a health plan? Further, the the rising medical costs again stress stress the need for every individual to be protected under a health plan. There are three key reasons why you need health insurance. You don't have enough savings to pay for healthcare. Getting treated at a top healthcare facility is costly. People find it challenging to manage their finances when a family member gets diagnosed with a dreaded illness. Nearly 44% of India's population is not covered by health insurances. In such situations, people dip into their savings or take loans or sell assets to fund treatments. However, the smart thing to do is to take a health insurance plan. This will help you to secure your finances and health at the same time. Healthcare costs are rising fast. The rate at which medical costs are rising makes it necessary to have health insurance medical trend rate, that is the increase in per person cost due to medical inflation in India itself is rated expected to rise at double the inflation rate. The forecasted medical trend rate will be 10% in India while inflation will be at 5%. Cancer and diseases of the circulatory system remains the top two highest claims reported by most insurers, followed by the gastrointestinal intestine followed by the gastrointestinal diseases and respiratory conditions which with a fixed benefit health insurance cover you can effectively fight critical illness like cancer and condition related to heart. Hospital cost includes various items. Treatment at hospital is not merely related to surgery. Medical checkups, doctor fees, and medicines can account for a higher chunk than the actual hospitalization expenses. Separately, there are diagnostic tests, post operative care, such as having a medical attendant at home, which also cost a lot. Add up all to understand why medical treatments seem so expensive. Health insurance plans offer coverage for several types of ailments and surgeries. They also cover other aspects of medical treatment. Fixed benefit health insurance plan gives the money without asking for a detailed description of all the aspect of treatment cost. It is paid upfront to the policyholder on the submission of first diagnosis report. Above we understood the need of health insurance. Now the next topic is importance of buying health insurance in India. The importance of buying health insurance is undeniable. Here's why buying a health plan is important. The first importance of buying health insurance is financial security. Sooner or later, everyone would want to lead a financially secure life, while achieving financial security is obviously linked to saving enough for the future. Getting insured is an equally important part of it. If you do not have a healthy health policy, then in this time of a medical need, you will have to pay it out of your savings, which would ultimately affect your finances. Health plans help you manage your emergency medical expenses so that you can utilize the saving in a better manner. Plus, the cherry on the cake is the tax exemption that you get A by SATD on the premium that you pay for your health policy. Second, shift in lifestyle. Lifestyle has changed a lot in recent times. If we have to travel a lot, sit for long hours at work, don't get time to take care of our health, and also neglect small signs of an accumulating health problem. All these things can lead to serious health problems in the future. Hence, health policy is more than a requirement as it includes regular medical tests, covers a range of medical treatments, and provides medical services at the best healthcare facilities. Early disease incidents, lifestyle changes, bad eating habits, and pollution are major factors that have led to an increase in the early incidence of a range of serious health disorders. Having a health plan allows you to avail of free annual health checkups from time to time, thus saving you from developing serious health problems. Fourth, rising medical cost. Healthcare expenses are unbelievably expensive, and it is estimated that the cost of medical expenses will rise further with the rise in inflation. So, to safeguard yourself against rising medical costs and stay financially secure, having a health plan is a must. Health insurance provides prompt access to medical treatment with the flexibility to customize your policy as per your healthcare needs. So don't wait. Cover yourself and your family with a family health insurance plan today. Fifth, money given upfront without medical bills. Fixed benefit health insurance plans pay the entire amount on diagnosis of the disease. Yes, there is no need to show actual proof of hospitalization and treatment, like hospital bills or treatment bills. In this way, such health insurance policies offer full coverage for both before and after hospitalization expenses. There are no pre specified durations or limits. If the policyholder is diagnosed with an ailment that is covered under the policy, the insurer will pay the money to the policyholder without asking any further questions. Sixth, treatment at a facility of your choice. With proper health insurance, you can get treatment anywhere in India and the world if you have the right amount of health cover. You do not need to compromise with the treatment. In a fixed benefit health insurance plan such as ICICI, Pruheart, or Cancer Protect, you get a lump sum payment upon diagnosis, which removes the hassle of getting admitted to a network hospital for cashless treatment. With the health insurance claim money, you can opt for treatment anywhere in the world as per your own wish and convenience. Seventh is high cover at low cost. Fixed benefit health insurance plan give high coverage amount for a comparatively low premium. This saves you money and also allows you to remain worry free even if diagnosed with a severe ailment. This saves you money and also allows you to remain worry free if diagnosed with a severe ailment. ICICI Pru Heart or Cancer Protect provides you with a cover of 20 lakh at rupees 387 per month for a 35-year-old healthy male for a policy term of 20 years and inclusive of tax. What's more, in case of minor claim or on the diagnosis of permanent disability due to accident, the premium is waived completely. Eighth, automatic increase in the sum assured amount. Health insurance is not just a cost effective way to manage medical treatment, it also gives you bigger coverage with every year you do not claim. ICICI Pru Heart Cancer Protect provides a 10% increase in sum assured if it is a no claim policy year. This means if there's a year where there's no claim, your premium money is not wasted. The premium paid is a no claim year gets you wider coverage. Ninth, fixed premium cost. Health insurance plans offer fixed benefit at a fixed premium. The premium amount in such special plans remains fixed for the entire duration of the policy. This means that your household budget is not put under any strain due to rising health insurance costs. Some plans even offer a discount on the first year premium if you and your spouse are covered. Ninth, tax benefits. Fixed benefit health insurance plan offer tax benefits. If you pay the premium, you can avail deduction up to Rs 25,000 from your taxable income on the health insurance premiums paid. This amount of benefit is available under Section 80D of the Income Tax Act. If your age is less than 60 years, if you and your family members are all more than 60 years old, the maximum deduction available is 50,000. The same benefit is applicable for premiums that you pay for your parents. Now, the new topic is health insurance policies. Health insurance is available in various forms. However, all the health insurance policies can be broadly categorized under two types: indemnity plan and fixed benefit plan. Let us understand these two types in detail. Indemnity plan. This plan covers hospitalization expenses up to a limit decided during the purchase of the policy. An insured can opt for multiple claims in the year, but the total amount given should not exceed the maximum sum insured limit or the amount you are entitled to get for the insurance company. This plan type is also known as Mediclaim policy. You also have the benefit of availing cashless treatment at various network hospitals where the insurance company pays on your behalf. Types of indemnity plans. First, individual insurance plans. This type of health insurance is meant for an individual. Thus, the insurance provider covers only the medical expenses incurred by an individual. The treatment expenses covered in these plans usually include all the costs incurred through hospitalization. Pre and post admission charges for various medical tests and laboratory charges and consultation charges. Since this risk cover is only for an individual, the premiums are cheaper than that of other plans. These individuals' Mediclaim policies don't cover any existing illness. However, after waiting for a certain period, these diseases might get covered by the insurance company. Many insurance policies do not cover Ayurvedic, homeopathic, or any other non-allopathic treatments. Second, family floater insurance plans. These type of insurance plans cover the entire family. Instead of buying different individual plans, you can get a family floater that would cover the medical and treatment expenses of all the family members. These plans include the policyholder, her spouse, and children. Minor children up to 2 years can also be covered under this plan. Some plans also include siblings and in-laws. Family floaters can provide health coverage for up to 15 relatives in one single plan. Thus, all the family members share some insured provided by the insurer. Third, senior citizen insurance. These insurance plans cover medical treatment or hospitalization expenses of individuals aged 60 years or more. Illness and other health related problems after the age of 60 years are common. Retirement might also deprive people of any longer income, of any regular income. In such a situation, bearing all the medical expenses might be a big burden. Thus, senior citizen health insurance plans can help in meeting medical expenses during emergencies. It is mandatory for the IRDA that the policyholder must be at least 60 to 65 years while applying for the policy. Some of the insurance companies also make people undergo medical examination before sanctioning a policy. The waiting period for these policies can range from 1 to 4 years in case of certain illness. Fourth, maternity insurance. Maternity insurance plans are specifically meant for women planning to have a child or are bearing one. It covers all the expenses before and after the pregnancy, the cost towards the child, mother's care expenses, and any complications that might arise due to pregnancy. Such a plan can be added to the main individual or family photo policy. Moreover, it can also be attached with a group insurance plan provided by the employers, which have a sublimit of up to 50,000. All the expenses related to tests, medicines, labor, and admission can be reduced by taking this plan. Any emergency transportation due to pregnancy related discomforts, expenses for delivery, nursing, and consultations are also covered in this plan. It also includes that congenital or a critical disease diagnosed in the newborn. The waiting period is up to a maximum of 4 years, as only after all the benefits can be availed. Hence, it is advisable to purchase this plan well before conceiving. The exclusions include charges for regular checkups, diagnostic exams, and consulting fees. Any medicines like vitamins during the pregnancy. Fifth point, group medical or employee insurance. Group medical insurance is provided by employers to their employees. The groups under such a policy include members of any association or companies, etc. Moreover, by paying some extra amount, employees can also extend the plan to include other family members like spouses, children, parents, etc. Like other plans, the premiums paid under this plan are tax exempt. Some policies also cover existing diseases and maternity expenditures. Unlike other plans, to purchase the plan, employees do not need to produce any documents or undergo any medical examinations. Also, the premiums are cheaper here. The plan can be contributory, where employees also pay a part of the premium, or non-contributory, where only the employer pays the premium. Now, the second is fixed benefit plan. This plan does not offer hospitalization benefit. It pays a fixed amount of certain listed critical diseases and conditions such as cancer, heart illness, etc. Under this plan, one also gets coverage on the diagnosis of certain diseases. Types of fixed benefit plans. Preventive insurance. A preventive health insurance plan covers expenses for regular health checkups required to prevent any dangerous illness like cancer. For this, an annual medical examination can be needed to analyze the possible symptoms. Such plans can provide coverage for any checkup done in network hospital of the insurer. Expenses also cover all the preventive measures taken for the policyholder, spouses, children, and parents. Children up to the age of 13 years are covered under this policy. Unlike other plans, the plan includes tests related to HIV or AIDS, cancer, or cholesterol. Second, critical illness. Critical illness are ailments not included in health insurance plans. These are some specific conditions which can lead to permanent disability or death. Some of the diseases covered by the plan include cancer, organ transplant, and failure, multiple sclerosis, paralysis, blindness, strokes, and heart attacks, kidney failures, coma, critical heart surgeries, among others. The policy provides a lump sum amount for the treatment of these diseases. This policy can be bought either separately or as an add-on with a life insurance plan. Under such a plan, if the policyholder is diagnosed with any of the critical illness included in the list within the tenure, he/she gets the claim benefit along with the other benefits. Some companies also provide a daily allowance benefit because the policyholder is unable to work income due to illness, and such plans usually have a lower waiting period. Third, hospital daily cash benefit. It offers fixed benefits usually after 24 to 48 hours of hospitalization. The coverage is over and above the benefits provided by a health insurance plan. This plan covers expenses usually not included in a health plan. You get a fixed amount every day during hospitalization. Fourth, personal accident. The plan offers coverage against accidental death and permanent, total, and partial disability of the policyholder. Such a policy would be great add-on with a motor insurance to cover the death or bodily injury to the driver. In case of an ultimately demise of the policyholder, the plan also offers sum assured to the family members to take care of various expenses and needs. No health documents are required to purchase this policy. It can be availed for both individuals and group. Also, many policies cover all the legal and funeral expenditures apart from covering any harm caused due to terrorist attacks. A personal accident cover can be classified into two types: individual accident cover and group accidental cover. Individual accident cover. The plan covers on individuals' disabilities, dismembering of body parts, or death due to an accident. Group accident cover. It is provided by employers to cover the expenses of the employee's family on his/her sudden demise. Government sponsored scheme. There are certain schemes initiated by the Government of India to make the health insurance accessible to the poor and destitute. Here we are discussing the scheme launched by the Government of India in details. First is Pradhan Mantri Suraksha Bima Yojana. The PMSBY is an accident insurance policy introduced by the Government of India for the citizens. It provides cover up to 2 lakh for accidental death or full disablement of the policyholder for just ₹1 per month. Any Indian citizens between the age of 18 to 70 years, regardless of their socio-economic status, can buy this policy. It can linked directly to a bank account, and the annual premium amount of ₹12 will be debited in a single installment from your bank account on or before 1 June every year. In case of death, and full disability, ₹2 lakh will be provided to the person insured under this scheme. Full disability is described as total and irrecoverable loss of both eyes and loss of use of both hands or feet, or loss of sight of one eye and loss of use of hands or foot. In case of partial disability, 1 lakh is provided. Partial disability is described as total and irrecoverable loss of sight of one eye or loss of use of one hand or foot. Second is Pradhan Mantri Jeevan Jyoti Yojana. 2 lakh is payable on the member's death due to any reason if the scheme member dies during insurable membership, subject to policy being in force and all the due premiums, service tax, and any other levies levies, if any, having been paid and subject to any restrictions or qualification referred to in these clauses. The amount specified as the sum assured for such scheme member shall become due to the nominee of the scheme member. No maturity benefit is payable under the policy. No surrender benefit is payable under the policy. First point, you can have only one subscription to the insurance policy regardless of the number of bank accounts you may hold. Second, the policy will be processed through the policyholder's Aadhaar linked bank account only. So, if you don't have Aadhaar card, time to stand in those long lines at the municipal corporation. To get the policy, you must authorize your bank during application to auto debit the premium amount at the time of renewal and ensure the continuation of the policy. Shout out to all broke people. You must have sufficient balance, that is rupees 12 for PMSBY and 330 rupees for PMJJBY in your linked bank accounts at the time of renewal each year. Failure to do so would result in the risk cover being suspended with reinstatement at the sole discretion of the insurance company. Your linked bank will be the master policy holder on behalf of you. Third is Rashtriya Swasthya Bima Yojana, RSBY. Rashtriya Swasthya Bima Yojana has been launched by Ministry of Labour and Employment, Government of India, to provide health insurance coverage for below poverty line (BPL) families. The objective of RSBY is to provide protection to BPL households from financial liabilities arising out of health shocks that involve hospitalization. Beneficiaries under RSBY are entitled to hospitalization coverage up to 30,000. For most of the diseases that require hospitalization, government has even fixed the package rates for the hospitals for a large number of intervention. Pre-existing conditions are covered from day one and there is no age limit. Coverage extends to five members of the family, which includes the head of the household, spouse, and up to 3 dependents. Beneficiaries need to pay only 30 rupees as registration fee, while central and state government pays the premium to the insurer selected by the state government on the basis of a competitive bidding for the Universal Health Insurance Scheme (UHIS). The 4 public sector general insurance companies have been implementing Universal Health Insurance Scheme for improving the access of health care to the poor families. The scheme provides for reimbursement of medical expenses up to 30,000 towards hospitalization floated amongst the entire family. Death covered due to an accident 25,000 to the earning head of the family, and compensation due to the loss of earning of the earning member rupees 50 per day up to maximum of 15 days. The Universal Health Insurance Scheme has been redesigned targeting only the BPL families. The premium subsidy has been enhanced from 100 to 200 for an individual, 300 for a family of 5 and 400 for a family of 7 without any reduction in benefits. Fifth, Aam Aadmi Bima Yojana AABY. Aam Aadmi Bima Yojana, a social security scheme for rural landless household, was launched on 2nd October 2007. The head of the family or one earning member in the family of such a household is covered under the scheme. The premium of rupees 200 per person per annum is shared equally by the central government and the state government. The member to be covered should be aged between 18 to 59 years. On natural death, 30,000. On death due to accident. On permanent disability due to accident, loss of 2 eyes or 2 limbs, 75,000. On partial permanent disability due to accident, loss of 1 eye or 1 limb, 37,500. Benefits. As a separate fund called Aam Aadmi Bima Yojana Premium Fund has been set up by the central government to pay the government contribution fund. It's maintained by LIC. A free add-on benefit in the form of scholarship to children is also available under the scheme. Eligibility criteria. Most of the insurance companies providing health insurance in India offer coverage to persons under the age of 45 years without any medical examination. They might ask details of any pre-existing diseases like diabetes or hypertension. However, those above 55 years need to undergo medical examination. Particulars are entry age and sum insured. Details are adults 18 to 70 years, dependent children 90 days to 25 years. Sum insured 50,000 to 6 crore. Topic is coverage of health insurance. Health insurance companies offer a plethora of plans and policies to choose from. As per your need and requirement, you should understand the coverage well before opting for a particular plan and policy. Let us look at some of the common points covered by different plans offered by health insurance companies. Pre and post hospitalization expenses. This insurance pays for medical expenses incurred between 30 and 60 days before hospitalization. These cover things like cost of medication and medical tests, etc. This is part of the usual coverage like meeting the cost of hospitalization of at least 24 hours, room rent, cost of surgery, etc. It also covers the medical expenses between 60 and 180 days after hospitalization, like that for medication, home treatment, etc. Ambulance charge. Almost all health insurance plans cover the expenses related to ambulance services, daycare charges. Some of the health insurance plans also cover the cost of treatment taken up without hospitalization of up to 24 hours. These include cases like dialysis, radiotherapy, chemotherapy, etc. Health checkups. Some of the health insurance companies also cover the cost of preventive health checkups. Documents required to process claims. In order to get the claim settled on time, certain specific documents are required, duly filled in claim form. Medical certificate from doctor, discharge summary, prescriptions, investigation report, pharmacy bills, FIR in case of accidents. Claim process. A health insurance policy helps manage any unforeseen medical expenses. Thus, in case of eventuality, you need to properly file claims in order to get the benefit. There are two types of claims: cashless and reimbursement claims. Cashless claims. To avail the kind of claim, you need to use one of the network hospitals, which is a hospital empaneled with the insurance company. Here, the policyholder does not have to pay the hospitalization expenses as it is borne by the insurance company. Let us understand the cashless claim process. In case of planned treatment, inform the insurance company in advance. This can be done through email or the toll-free number. On hospitalization, provide the health card given by the insurance company to the third-party administrator desk of the hospital along with an approval from the treating doctor. Also submit the required documents. Once the insurance company approves the case, it pays the medical expenses directly to the hospital. Reimbursement claims. Here the policyholder makes the payment for the treatment and hospitalization. However, she gets back the money later as per the sum insured amount. After submitting the required documents, let us understand the reimbursement claim process. After paying the medical expenses on your own, submit the bills and other required documents to the insurance company. After an evaluation, if the insurance company finds the claim fit, it will make the payment to the insurer. Third, time taken to settle claims. After receiving a claim request, a health insurance company usually takes 30 days for the day of receipt of documents to settle the claim. However, if there is any kind of investigation needed to process the claim, it usually takes 45 days to settle down the claim after the time of receipt of documents. Exclusions. Health insurance provides coverage of various kinds of medical expenses, treatments, and illness to help you manage your finances better. However, certain situations and cases are not covered by health insurance plans. Though the list varies for different providers, always understand these exclusion well before finalizing a plan so that you do not face problems later. Let us look at some common exclusions. Dental treatment, including surgery, treatment for AIDS and other sexually transmitted diseases. Life insurance and non-life insurance scheme. Introduction. No one plans to get in an accident or become seriously ill. The chances of these things happening to you may be very small, so we may put off buying the insurance we need. But these things do happen. It's only when the event occurs that we realize that we may not be as well protected as we would wish. Insurance is a way to protect yourself and your loved ones from financial hardship in case losses occurs. in case losses occurs. In practice, many policies provides a mixture of savings and protection benefits. In this chapter, we are going to discuss about the life insurance and non-life insurance scheme. First, life insurance. When you buy a life insurance policy, you name a beneficiary. Life insurance provides a financial payment to your beneficiary upon your death. First of all, everything you do about life insurance will be meaningless if you don't accept your own mortality and your family's need in the aftermath aftermath of your death. If this may sound self-evident, however, a remarkable number of people speak of their own death in terms of it. Not when, so the starting point for a discussion of life insurance is literally to imagine that you are going to die tomorrow. Life insurance in a discussion of life insurance is literally to imagine that you are going to die tomorrow. Life insurance in its pure form is meant to replace your income in the event of premature death. If you are married in a committed relationship or have a children who depend on your income, you need life insurance. If you have a stay at home spouse or partner caring for your home and children, you would be faced with some very substantial cost to replace those services in the event of his or her premature death. Then sit down and figure out what you want to happen afterward. Obviously, the answer will depend on the specification of your own particular circumstances, family structure, need of life insurance. For life insurance to be necessary, two components need to be true. The first is that there must be lost economic value for the death of someone. Typically, the lost value represents the further earning power of the individual. Future earning power alone is not enough to justify life insurance on their life, though. To real life insurance, another person or group of people must depend on the future earning power to somehow. It could be a company depending upon the person's ability to bring in revenue, or it could be a spouse depending on the income from a job to pay for living expenses. Either way, both a future income earning potential and a reliance on the future income by another must be present to create an economic necessity for life insurance case. Amit is a 25-year-old qualified welder who is subcontractor of various builders. He is earning 70,000 gross but pays 20,000 in expenses, most which are fixed expenses, that is a leased car and a leased equipment. Amit rents an apartment and spends the rest of his earning of 50,000 on living and entertain expenses. Amit has little in the way of savings. Why insurance is important? In this case, if the Amit has a car accident and is hospitalized for 1 month, he then faces a long and painful rehabilitation process of 12 months to try to regain the use of one of his arms. Even this private health insurance, there are medical bills to be paid, particularly for physiotherapy and rehabilitation sessions. Amit has no income for 13 months but must continue to pay his lease cost of 20,000 per annum. What little money Amit receives in disability payments from the government won't cover his rental cost. Amit has to move back home and borrow money from his parents. If he doesn't recover the use of his arm, Amit will never be able to work as a welder again and will have to retrain into a potentially lower paid job. Principles of life insurance. Life insurance is based on number of principles that are tailored to meet market condition and to ensure insurance companies make profit while offering security policies in secured individual. Principles of insurance. Uh, Principle of utmost good faith, principle of insurable interest, principle of indemnity, principle of contribution, principle of subrogation, principle of loss minimization, principle of causa proxima. They are broadly four main insurance principles applied in India, these being insurance interest. The principle pertains to the level of interest an individual is expected to have in a particular policy. The interest could be a family bond, a personal relationship, and so on. Based on the interest level, an insurance company can choose to accept or reject an application in order to protect the misuse of a policy. Law of large numbers. This is a theory that ensures long-term stability and minimizes losses in the long run when experiments are done with large numbers. Good faith. Purchasing insurance is entering into a contract between company and individual. This should be done in good faith by providing all relevant details with honesty. Covering any information from the insurance company may result in serious consequences for the individual in the future. This being said, the insurer must and explain all aspects of a policy and ensure that there are no unexplained or hidden clauses, and that the applicant is made aware of all the terms and conditions. Fourth, risk and minimal loss. Insurance is a risky and companies have to do business and make profits. Keeping in mind the risk factor, the principle of minimal risk states that the insured individual is expected to take necessary action to limit hers, herself from any hazards. They include following a healthy lifestyle, getting a regular health checkups, and more. Need for insurance planning. Insurance plans are beneficial to anyone looking to protect their family, assets, or property and themselves from a financial risk or losses. Insurance plans will help you pay for medical emergencies, hospitalization, contraction, or any illness and treatment and medical care required in the future. The financial loss of the family due to unfortunate death of the sole earner can be covered by insurance plans. The family can also repay any debts like home loans or other debts which the person insured may have incurred in his or her lifetime. Insurance plans will help your family maintain their standard of living in case you are not around in the future. This will help them cover cost of running the household through the insurance lump sum payout. The insurance money will give your family some such much needed breathing space along with coverage of all the expenditure in case of death, accident, medical emergency of the policyholder. Insurance plan will help in protecting the future of the child in terms of his or her education. They will make sure that your children are financially secure while pursuing their dreams and ambitions without any compromises even when you are not around. Many insurance plans come with savings and investment schemes along with the regular coverage. These help in building wealth savings for the future through regular investments. You pay premium regularly. Add a portion of the same goes towards life coverage while the other portion goes towards either a saving plan or investment plan, whichever you choose based on your future goals and needs. Insurance plans protect your home in the event of any unforeseen calamity or damage. Your home insurance plan will help you get coverage for damages to your home and pay for the cost of repair or rebuilding, whichever is needed. If you have coverage for valuables and items inside the house, then you can purchase replacement items with the insurance money. How to decide on the best life insurance plan that suits your needs? Before deciding on the best life insurance plan, you should understand some basic steps that will lead you to make the right decision. Need based policy. The policy should be need based. It means you should assess the number of dependents in the family, the source of income, and the monthly commitment before you decide on the life insurance policy. You should also draw a list of goals that you have set for yourself, like education of your children, marriage of your children, retirement plans, buying a dream house, etc., and plan the investment accordingly. Seek the help of an advisor. There are insurance advisors who can help you with your decision. They will consider all the angles like the sources of income, monthly expenditure as per your lifestyle, the number of dependents, your assets and liabilities, etc., and will arrive at a sum assured. They will be able to advise you on which plan to choose. They will help you choose the plan that would give you optimum returns for the investment. The plans could be term plans, unit linked plans, endowment plans, or a combination of the plans. So it is necessary to seek the advice of these insurance advisors if you are confused about the best plan for you. Compare products. There are a lot of players in the market giving various benefits with varied premium levels. Compare the products and choose the one that would give you optimum benefit for the least investment. You can compare the different policy on policybazaar.com. Types of life insurance policies. Broadly speaking, life insurance can be further categorized as a pure risk coverage plan, purely insurance, and the other which is a combination of insurance and investment component, but maybe you are not sure which plan to opt for, or maybe you need to know the different types of the life insurance policies available in the market to make a wise choice. Term plan. First, pure risk cover. Second, unit linked insurance plan, ULIP. Insurance plus investment opportunity. Third, endowment plan, insurance plus savings, money back, periodic returns with insurance cover. Fifth, whole life insurance, life coverage to the life assured for whole life. Sixth, child's plan for fulfilling your child's life goals like education and marriage, etc. Retirement plan, plan your retirement and retire gracefully. Let's dive deeper to know each plan in detail. Terms Term life insurance. Term insurance is the simplest form of life insurance plan, easy to understand and affordable to buy. A term insurance provides death risk covers for a specified period. In case of the life assured passes away during the policy period, the life insurance company pays the death benefit to the nominee. It is a pure risk cover plan that offers high coverage at low premiums. There's an option to add riders to widen up the coverage. The death benefit is payable at lump sum, monthly payouts, or a combination of both. Most people elect to receive their death benefit as a lump sum. The term insurance is considered the simplest, most accessible insurance policy. There is no payout of in the life assured outlives the policy terms. However, these days there are companies offering term plans with return of premiums (TROPS), where insurance companies pay back all the paid premiums amount in case the life assured outlives in the terms period. But such plans are costlier than the vanilla term insurance plan. Example, an individual non-smoker male who is looking for a term life plan for 1 crore cover will cost him approximately 66,800 to 10,500 per year. Age 25 years, term 40 years, sum assured 1 crore, annual premium range 6,800 to 10,500. Benefit of term plan. In case of untimely death of the breadwinner, family supported with an enormous amount of money, sum assured, which help them to replace the loss of the income caused due to the breadwinner's death. Moreover, the money could be utilized to pay off loan, monthly household expenses, child's education, child's marriage, etc. Whole life insurance, on the other hand, is considered a permanent life insurance policy. Under this policy, the insured is covered for a lifetime, that is, till his or her death. The maturity is usually 100 years, thus you need to keep paying the premiums till 100 years of your age. Here, the beneficiary gets the sum assured along with the maturity benefits on the untimely demise of the policyholder. On the other hand, the policyholder gets to enjoy survival benefits in case he/she happens to survive the policy term. A whole life insurance plan offers benefit in both the cases when the policyholder survives the policy or on his or her sudden demise during the term. Due to the fees and the extra feature, a whole life insurance policy can cost 5 to 15 times as much as term life policy for the same death benefit amount. Whole life lasts for as long as you pay the premiums. However, the cash values component can make whole life more complex than term life because you have to consider surrender fees, taxes, and interest as well as the other stipulations.
Basic tax structure. 13.1 Introduction. India offers a well structured tax system for its population. Taxes are the largest source of income for the government. This money is deployed for various purposes and projects for the development of the nation. The government collects money from the general public in the form of taxes, which it uses for different developmental schemes and functioning of the economy. The general public may comprise salaried people, business people, industrialists, and many other service providers. All these people pay taxes with the expectation that the government would function efficiently. In your lifetime, you definitely have to pay taxes. The prices that we pay when we buy things in the market is exclusive of taxes that have been charged on them. We bear taxes when we spend money and also when we earn money. Not many of us willingly part with their hard earned money for taxes. You must have often heard your elders say, "What do we get that we should pay taxes?" Payment of taxes is not only the duty of every citizen, but an essential requirement for existence of a country as a prosperous, secure, stable, and a just nation. You know that government spends money for providing many public services like highways, police, defense, etc., and basic facilities like school and hospital to the poor and underprivileged, thus creating an egalitarian society. It is also used for funding developmental programs and services. Government gets money from taxes, and therefore it is vital for all citizens to pay taxes. However, at the same time, it is important for us to learn to be wise and smart so that all taxes that we legally owe are paid and not a rupee anymore. Tax structure of India. India has a well developed taxation structure. The tax system in India is mainly a three-tier system comprising the central government, state government, and the local government's organization, which includes panchayats and municipalities. The government cannot impose any tax unless it is passed as a law. The entire system is clearly demarcated with specific rules for the central and state government. The central government of India levies taxes such as custom duty, income tax, service tax, and central excise duty. The taxation system in India empowers the state government to levy income tax on agricultural income, professional tax, value added tax or VAT, state excise duty, land revenue, and stamp duty. The local bodies are allowed to collect octroi, property tax, and other taxes on various services like drainage and water supply. 13.3 Types of taxes. As said earlier, we pay different types of taxes to the government, which can be classified as direct and indirect. Direct taxes are those that are imposed and paid by the taxpayer directly to the government, like taxes on income and wealth. Indirect taxes are those that we pay indirectly to the government, like taxes on commodities. As understanding of these taxes is necessary for us to be aware of the payments that we have to make, taxes are classified under two categories, namely direct and indirect taxes. The largest difference between these taxes is their implementation. Direct taxes. Direct taxes are paid by the assessee, while indirect taxes are levied on goods and services. Direct taxes are levied on individuals and corporate entities, which cannot be transferred to others. These include income tax, wealth tax, and gift tax. Income tax. A tax levied against people or organization about their income or profits is known as income tax, commonly called taxable income. Tax rates multiplied by taxable income are typically used to calculate income taxes. Taxes are the primary source of funding for the government. Taxation is the process of levying taxes. A tax is a mandatory levy or charges the government imposes on people or businesses. No matter whether the government receives a similar return on the goods and services, the taxed parties are still required to pay the taxes. The income and wealth of individuals or corporations may be subject to taxes, which may also vary in rate. Salaried workers make up the majority of the nation's taxpayers overall and thus have substantial impact on the amount of taxes collected. The salaried class has access to various tax saving alternatives through income tax deductions. One could significantly lower their tax obligations using these deductions and exemptions. There are 120 exemptions under the previous tax regime. Not all of them provide benefits to taxpayers. Most of these make the direct tax system more complicated. The Ministry of Finance has eliminated over 70 exemptions after careful consideration. The new tax system does not permit maximum deductions. Number two, indirect taxes. Indirect taxes are not directly paid by the assessee to the government authorities. These are levied on goods and services and collected by intermediaries, that is, those who sell goods or offer services. Here are the most common indirect taxes in India. Value added tax. This is levied by the state government and was not imposed by all states when first implemented. Presently, all states levy such tax. It is imposed on goods sold in the state and rate is decided by the government. Number 2, custom duty. Imported goods brought into country are charged with custom duty which is levied by the central government. Number 3, octroi. Goods that move from one state to another are liable to octroi duty. This tax is levied by respective state governments. Excise duty. All goods produced domestically are charged with excise duty, also known as Central Value Added Tax, that is CENVAT. This is paid by the manufacturers. Number 5, service tax. All services provided domestically are charged with service tax. The tax is paid by all service providers unless specifically exempted. Number 6, good and services tax or GST. As a significant step toward the reforms of indirect taxation in India, central government has introduced the good and services tax, that is GST. GST is a comprehensive indirect tax on manufacture, sale and consumption of goods and services throughout India and will subsume many indirect taxes levied by the central and state governments. GST will be implemented through central GST, that is CGST, integrated GST, IGST, and state GST, SGST. Four laws, IGST, CGST, UTGST, and GST, Compensation to the States Act, have received precedent assent. All the states and UT expected to pass State GST Act by end of May 2017. GST law is expected to take effect from July 1, 2017. GST has three components. Number 1, CGST stands for Central Good and Services Tax. The central government allows this tax on an intrastate supply of goods or services. SGST. Number 2, stands for State Goods Services. The state governments collects this from intrastate supply of goods or services. Number 3, IGST. It stands for Integrated Goods and Services Tax. The central government collects this for interstate sale of goods or services. In order to understand the tax structure of India, we can see that it is divided into three parts. Direct tax include income tax, agricultural tax, and corporate tax. Indirect tax includes GST and custom duties, and tax on tax includes surcharge and cess. 13.4, Revenue Authorities. CBDT. The Central Board of Direct Taxes or CBDT is a part of the Department of Revenue under Ministry of Finance. This body provides inputs for policy and planning of direct taxes in India and is also responsible for administration of direct tax laws through the Income Tax Department. CBEC, the Central Board of Excise and Customs, is also a part of Department of Revenue under the Ministry of Finance. It is the nodal national agency responsible for administering customs, central excise duty, and service tax in India. CBIC. Under the GST regime, the CBEC has been renamed as the Central Board of Indirect Taxes and Customs, CBIC, post legislative approval. The CBIC would supervise the work of all its field formations and directorates and assist the government in policy making in relation to GST, continuing central excise levy and custom functions. Basic definitions. Compulsory monetary contribution to the state's revenue, assessed and imposed by a government on the activities, enjoyment, expenditure, income, occupation, privilege, property, etc. of individuals and organizations. Assessment year. Assessment year is the period of 12 months, starting from the first day of April every year. An assessment year begins on 1st April every year and ends on 31st March of the following year. For example, the assessment year 2018-19 means the period of 1 year beginning on 1st April 2017 and ending on 31st March 2018. Also, in an assessment year, the income of assessees during the previous year is taxed at the rates prescribed by the relevant Finance Act. It is therefore also called the tax year. Previous year. Previous year as a financial year immediately preceding the assessment year. Income earned in one financial year is taxed in the next financial year. The year in which income is earned is called previous year, and the year in which it is taxed is called assessment year. Common previous year for all source of income. A person may earn income from more than one source, but the previous year will always be typical for all sources of income. This will be so even if a person maintains records or books of accounts separately for different sources of income. The total income of person from all sources of income will be taken together and considered in the previous year on the financial year immediately preceding the assessment year. Person. There are seven categories of persons chargeable to tax under the Act. The aforesaid definition is inclusive and not exhaustive. Therefore, any person not falling in the above mentioned seven categories may still fall within the four corners of the term person and accordingly may be liable to tax. Assessee. Assessee means a person by whom income tax or any other sum of money is payable under the Act, and it includes every person in respect of whom any proceeding under the Act has taken for assessment of his income or loss or amount of refund due to him. A person who is assessable in respect of income or loss of another person, or who is deemed to be an assessee or an assessee in default under any provision of Act. 13.5. Various heads under income tax. Under income tax 1961, the tax is being calculated into five categories under five heads of income tax: income from salary, income from house property, income from profits and gains from business or profession, income from capital gains, and income from other sources. Income from salary. Any income that you receive in terms of service you provide on contract of employment is applicable for taxation under this head. This includes salary, advance salary, perquisites, gratuity, commission, annual bonds, and pension. This tax head also includes some exemptions. House rent allowance. As a salaried individual, if you live in a rented house, you can claim house rent allowance for partial or complete tax exemptions. Conveyance allowance. You can get a monthly tax exemption of up to rupees 800. Income from house property. An individual's income from his or her property or land is taxable under the head of income from house property. To put it simply, this head includes the policy for calculating the tax on rental income that you receive from your properties. If you own more than one self occupied house, then only one house is considered to be occupied and the rest are considered to be rented out. The taxation occurs on income received from both commercial and residential properties. Income from profits and gains from business or profession. The profits that you earn from any kind of business or profession are taxable under this head. You can subtract your expenses from the total income to determine the amount on which tax is chargeable. Here are types of income that are chargeable under this head: profits generated from selling a certain license, gains generated by an individual during an assessment year, the profits that an organization makes on its income, cash received on the export of a government scheme, the benefits that a business receives, gains, bonuses, or salary that an individual receives due to partnership with a firm. Income from capital gains. When you earn profits by transferring or selling an asset that was held as an investment, that income is taxable under the head of income from capital gains. Many assets like gold, bonds, mutual funds, real estate, stock, etc., fall under capital assets. Now you can subdivide capital gains into short term capital gains and long term capital gains. When you sell your capital assets after holding them for a period of 36 months or more, they will fall under long term capital gains and will have a tax rate of 20%. Alternatively, if you sell your capital assets within a period of 36 months, tax deduction will be under short term capital gain at rate of 15%. In case of securities, this is applicable if you sell your holdings within 12 months from the purchase date. Income from other sources. One time income such as winning from lotteries, horse races, crossword puzzles, card games, gamblings, or betting of any form are categorized under income from other sources. 13.6. Income tax slab. Income tax is levied on the income earned by all individuals, HUF, partnership firms, LLPs, and corporates as per the Income Tax Act of India. In the case of individuals, tax is levied as per the slab system if their income is above the minimum threshold limit, known as the basic exemption limit. What is income tax slab? Indian income tax levies tax on individual taxpayers based on slab system. A slab system means different tax rate are prescribed for different income ranges. It means the tax rate keep increasing with an increase in taxpayers' income. This type of taxation enables progressive and fair tax systems in the country. Such income tax slabs tend to undergo a change during every budget. These slab rates are different for different categories of taxpayers. Income tax has classified three categories of individual taxpayers, such as individuals aged less than 60 years, including residents and non residents, resident senior citizens 60 to 80 years of age, resident super senior citizens aged more than 80 years. Number 2. Income tax slab rates for financial year 2021 to 2022, for which the assessment year will be 2022 to 23. Income tax slab rate for this under new tax regime. Why is it optional? In this new regime, taxpayers have an option to choose either to pay income tax at lower rate as per new tax regime on the condition that they forego certain permissible exemptions and deductions available under income tax, or to continue to pay taxes under the existing tax rates. The assessee can avail of rebates and exemptions by staying in the old regime and paying tax at the existing higher rate. There are old tax slabs, that is 2019-20, and new tax slabs, that is 2022-23. The taxpayer has an option to choose from any of the tax slab according to tax liability. In old tax slabs for and new tax slabs, income up to rupees 2.5 lakh were not charged with any tax. That is, they were below minimum threshold limit. Income from 2.5 to 5 lakh were charged with 5% of tax. However, the difference starts coming from incomes following this. In old tax slab, income of 5 to 10 lakh is charged with 20% tax, and income of 10 lakh and above is charged with 30%. However, in new tax slabs, there are further divisions. Income of 5 to 7.5 lakh is charged with 10%, 7.5 to 10 lakh is charged with 15%, 10 to 12.5 lakh is charged with 20%, 12.5 to 15 lakh is charged with 25%, and 15 lakh and above is charged with 30%. In case of senior citizens, income up to rupees 3 lakh is exempted. In case of senior citizens, income slab applicable is for income between 3 lakh to 5 lakh. Income tax slabs for individual aged below 60 years and HUF. Income tax slab up to rupees for income of up to rupees 2.5 lakh nil. From 2.5 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, 20%. More than 10 lakh, 30%. Note: income tax exemption limit is up to 2 lakh, 50,000 for individuals, HUF below 60-year age, and NRIs. An additional 4% health and education cess will be applicable on tax amount calculated as above. Surcharge. Surcharge is an additional charge levied for person earning income above the specified limits. It is charged on amount of income tax calculated as per applicable rates. 10% taxable income amount above rupees 50 lakh up to rupees 1 crore. 15% when taxable income amount is above 1 crore up to rupees 2 crore. 25% when it is above rupees 2 crore up to rupees 5 crore. 37% when it is above 5 crore. Maximum rate of surcharge on income by way of dividend or income under the provision of sections 111A, 112A, and 115AD is 15%. The tax calculated on basis of such rates will be subject to health and education cess of 4%. Any individual opting to be taxed under the new tax regime from financial year 2020 to 21 onwards will have to give up certain exemptions and deductions. Points to remember while opting for new tax regime. Option to be exercised on or before the due date of filing return of income for assessment year 2022-2023. And in case a taxpayer has business income and exercise the option, he or she can withdraw from the option only once. A business taxpayer withdrawing from optional tax regime has to follow the regular income tax slabs. Income tax calculator 13.7. What is income tax calculator? It is an easy to use online tool that helps you estimate your taxes based on your income after the union budget is present. We have updated our tool in line with the income tax changes proposed in the union budget 2022-23. How to use the income tax calculator for the present financial year and the assessment year 2023-24. Following are steps to use the tax calculator. Choose the financial number 1. Choose the financial year for which you want your taxes to be calculated. Number 2. Select your age accordingly. Tax liability in India differs based on age groups. Number 3. Click on Go to Next Step. Number 4. Enter your taxable salary, that is, salary after deducting various exemptions like HRA, LTA, standard deduction, and so on, if you want to know your tax liability under old tax slabs. Or else, number 5, just enter your salary, that is, salary without availing exemptions such as HRA, LTA, standard deduction, professional tax, and so on, if you want to know your tax liability under the new tax slab. Number 6. Along with taxable salary, you must enter other details such as interest income, rental income, interest paid on home loan for rented, and interest paid on loan for self occupied property. Number 7. For income from a digital assets, enter the net income. Sale consideration less cost of acquisition. Such income is taxed 30% plus applicable surcharge and cess. Number 8. Click on Go to Next Step again. Number 9. In case you want to calculate your taxes under the old tax slabs, you will have to enter your tax saving investments under Section 80C, 80D, 80G, 80E, and 80TTA. Number 10. Click on Calculate to get your tax liability. You will also be able to see a comparison of your pre budget and post budget tax liability, old tax slabs, and new tax slabs. How to calculate income tax? The income tax calculated for the salaried. The income from salary is sum of basic salary plus HRA plus special allowance plus transport allowance plus any other allowance. Some components of your salary are exempt from tax, such as telephone bill reimbursement and leave travel allowance. If you receive HRA and live on rent, you can claim an exemption on HRA. Calculate exempt portion of HRA by using the HRA calculator. Now we can have a look at a practical example. Taxpayers with annual income between rupees 5 lakhs to rupees 10 lakhs are taxed at 20% under the old regime, and in the new regime they will be taxed at half that rate, that is 10%. Also, those with annual income of rupees 7.5 lakh to rupees 10 lakh will have to pay 15% an income tax. However, if the taxpayer is benefiting from exemption and his net tax payable is less, he or she can choose to continue with the old tax regime. Let's take an example. A person's annual income comes to rupees 6 lakh. If he goes by the new rates, he will have to pay rupees 60,000. Some of the exemptions allowed in the new tax regime may be beneficial. If he chooses the old rates, he can deduct rupees 1.5 lakhs under Sec 80C. His taxable income now is rupees 4.5 lakhs. A simple preview of how much does the tax amount come to under different slabs with old and new tax regime will help you take the right call. Not everyone might invest in the same manner to save tax. If a person is not benefiting from the exemptions, he or she can choose the new tax regime. A simple preview of how much does the tax amount come to under different slabs with old and new tax regime will help you take the right call. We can understand this from one question. Question 1. Mr. Aman is a salaried person and earns rupees 7,50,000 per annum. His contribution to PF is rupees 1 lakh and he paid tuition fees for his child education is rupees 50,000. He is claiming HRA exemption of rupees 10,000. He is also contributing rupees 50,000 towards NPS. calculate his total tax liability under old tax regime and new tax regime. So for annual income up to rupees 7,50,000 with exemptions, if we are calculating it with old regime, that is for financial year 21-22, we can see that the gross total income would be 7,50,000. The various deductions here are less standard deduction rupees 50,000, total deduction US ATC 1,50,000, US ATCCCD under section 1B 50,000, HRA 10,000. This makes it a total of 2,60,000. Thus the taxable income becomes 4,90,000. The tax on total income here is 1 lakh is 12 the tax on total income here is 12,500, while the rebate is also 12,500. There is no added surcharge here, and health and education cess is 0. Total tax payable here thus becomes 0. However, when we talk about the new regime, that is financial year 21-22, the gross total income would remain same, that is 7,50,000. However, in this, Mr. Aman will not be making any deductions. Thus, it is his deductions are rupees 0. This makes his taxable income rupees 7,50,000. The tax on total income would be 37,500 and rebate would be 0. Surcharge is not applicable here. Thus, health and education cess of 1,500 would be applicable, which makes total tax payable 39,000. So we can see that if we are claiming deduction, we have to pay nil tax on our income. And if we adopt the new tax regime, we have to pay 39,000 as tax. If we don't want to make any saving, then new tax regime is better.
Comparison between term life and whole life insurance. Term life insurance suitable for persons who want only protection for a predefined period. Whole life insurance suitable for persons who want both protection as well as maturity benefit. Term life insurance, only death benefit is available and no maturity benefit. Whole life insurance ideal for persons who are planning for a future corpus. Term life provision for riders like critical illness, permanent disability due to an accident, hospital, cash, etc. is available. Whole life insurance, the cover is available for a lifetime, that is until the insured is alive. Term life insurance offers protection to dependents against debts. Whole life insurance, the policy holder can surrender the policy if she wishes to discontinue and obtain a lump sum by way of the surrender value of the policy. Term life insurance, high returns for low investment. Whole life insurance, there is no provision for riders in this policy. Term life insurance premium need not be paid until the maturity of the policy. Premium has to be paid only for a limited term as per the stipulation in the contract. Whole life insurance, the dependents can only get a death benefit but no protection against debts. Both the death benefit and the maturity benefit are provided. Premium has to be paid for a premium payment term. Premium is much higher than when compared to the premium of the term plan. An option to avail a loan when in need of funds is available. Another topic, unit linked plans. A unit linked plan is a comprehensive combination of insurance and investment. The premium paid towards ULIP is partly used as a risk cover, that is insurance, and partly is invested in funds. One can invest in different funds offered by the insurance company depending on his risk appetite. The insurance company then invests the accumulated amount in the capital market, that is in bonds, equities, debts, market funds, or a hybrid fund. Example, term 20 years, sum assured 2 lakh, annual premium 20,000, fund value depending on the fund value at the time of maturity. Best known for long-term investment option with much more flexibility to invest. Benefit of ULIP. Invest money as per your risk appetite. You have the option to invest either in equity, debt, or in hybrid funds through the life insurance company with complete transparency. Another topic, endowment plans. Endowment plan is another type of life insurance plan, which is combination of insurance and saving. A certain amount is kept for life cover insurance while the rest is invested by the life insurance company. In an endowment plan, if the life assured outlives the policy term, the insurance company offer him the maturity benefit. Moreover, endowment plans may offer bonuses periodically, which are paid either on the maturity or the nominee, either on the maturity or to the nominee under death claim. The death benefit is payable to the nominee. Endowment plans are also commonly known as traditional life insurances. Although there is an investment component, but the risk is lower than the other investment products, and so are the returns. Example, term 30 years, sum assured 10 lakh, annual premium range 20,000 to 25,000, bonus depending on the bonus at the time of maturity. Another topic is retirement plan. Retirement plan helps to build corpus for your retirement, helping you to live independently, financially, and without worries. Most of the child plans provide annual installments or one-time payout after the age of 60 years. In case of an unfortunate event, life assured passes away during the policy term. Immediate payment is payable to the nominee by the insurance company. Death benefit will be higher of coverage or fund value of 105% of premiums paid. Vesting benefits will be payable if the life assured survives the maturity age, in which case payout will be fund value which has to be utilized for buying an annuity. Other types of life insurance. First is group life insurance. Group life insurance is a type of life insurance that covers a group of people. It is mostly provided by the companies to its employees. As the insurance is done in a group life insurance is considered cost effective. The group can comprise lawyers, members of cooperative banks, societies, doctors, etc. This life insurance can be contributory, where the employees contribute along with the employer in the payment of the premium, or non-contributory, where the employer pays the entire premium amount. Second, life insurance for senior citizens. You can brave various situations of life when you are young. However, in old age, you need more protection and security to manage such circumstances of life. In old age, life insurance for senior citizens can be a good option. The insurance also provides financial coverage at times of need. For instance, in case you do not have any support for your spouse, life insurance for senior citizens can provide financial security to the spouse in case of your sudden demise. The death benefit can also be used to manage loans, debts, and other financial needs. Now, another life insurance, claim settlement process, the next topic. On the happening of the event, the beneficiary is required to send claim intimation form to the insurance company as soon as possible. Claim intimation should contain details such as date, place, and cause of death. On successful submission of claim intimation form, an insurance company can ask for additional information about certificate of death, copy of insurance policy, legal evidence of title in case insured has not appointed a beneficiary, deeds of assignment. On successful submission of all the documents, the insurance company shall verify the claim and settle the same. Life insurance companies in India. Some of the prominent life insurance companies in India are LIC, Life Insurance Corporation of India, SBI Life Insurance, ICICI Prudential Life Insurance, HDFC Standard Life Insurance, Bajaj Allianz Life Insurance, Max Life Insurance, Birla Sun Life Insurance, Kotak Life Insurance. We all are uncertain of the future, and although no one wishes anything unfortunate to happen to them, we should be prepared for unforeseen circumstances. Having a life insurance policy is a financial cushion that makes sure your family is well protected. A life insurance policy, hence, is a very small investment compared to the greater peace of mind it will bring you. Non-life insurance. A general insurance is a contract that offers financial compensation on any loss other than death. It insures everything apart from life. A general insurance compensates you for financial loss due to liabilities related to your house, car, bike, health, travel, etc. The insurance company promises to pay you a sum assured to cover damages to your vehicle, medical treatments to cure your health problems, losses due to a theft or fire, or even financial problems during travel. Car insurance, bike insurance, fire insurance, home insurance, etc. Simply put, a general insurance offers financial protection for all your assets against loss, damage, theft, and other liabilities. It is different from life insurance. Example of non-life insurance policies include automobiles policies, homeowners policies, damage covers from fire, marine accidents, travel theft, and any catastrophe, etc. Since the probability of occurrence of these risks is very difficult to ascertain, it thereby is an extremely difficult task to measure the amount of damage they would do. On their incidence, general insurance covers non-life assets such as your home, vehicle, and health travel from floods, fire, thefts, accidents, and man-made disasters. General insurance is an annual contract with a lump sum premium. Example of non-life insurance are fire, marine, motor, health insurance, home, factory, shop, travel, and liability insurance, etc. In other words, you can say that other than life insurance products, the type of insurance that provide cover are non-life insurance products. Different type of risk included in insurance. Mortality risk, that is risk of death. The financial planning process for an individual begins by identifying the various goals at different stages of life. To achieve them, one has to be alive and keep funding them till they arrive. However, the risk of an early death exists, which could derail the entire investment process. The surviving member of the family, in addition to the mental trauma, could also suffer from the loss of income, thereby making long-term goals vulnerable to the circumstances. Mortality risk is the risk that an insurance company can suffer financial because too many of their life insurance policyholders die before their expected lifespans. Actuaries working for insurance companies rely on mortality tables to make informed assumptions about how long their policyholders will live. With these estimates, they can get an idea of how much they will earn in premiums compared to how much they will pay out in death benefits or annuitizations. If a fair number of their policyholders die well before their life expectancy, the insurer will make less profit than anticipated. Risk of mortality, ROM, provides a medical classification to estimate the likelihood of in-hospital death for a patient. The ROM classes are minor, moderate, major, and extreme. The ROM class is used for the evaluation of patient mortality. Risk of disability. In this, a person becomes disabled owing to an accident. For example, a person who has lost his or her legs in an accident is called permanently totally disabled. Those with impaired or broken limbs are also covered under accidental disability. Even an individual with partial or complete vision loss caused due to an accident is covered. Most of the health insurance companies treat accidentally disabled individuals as normal applicants. They do not impose extra charges and has no restrictive clauses for providing coverage. In most cases, people who suffer from accidental disabilities are treated as normal applicants without any need for additional medical tests or higher premiums. At the time of signing up for a policy, without any need for additional medical tests or higher premiums, at the time of signing up for policy, all accidental disabilities must be declared by the applicant in advance. Once the insurer verifies all the details, the PWD can subscribe to a health insurance policy without any restrictive clauses or additional premium. Risk of property. Property insurance guards against catastrophic losses of real and personal property caused by such perils as fire, theft, vandalism, windstorms, and other calamities. In this chapter, we discuss property insurance and home insurance. Property insurance provides protection against most risks of property such as fire, theft, and some weather damage. This includes specialized forms of insurance such as fire insurance, flood insurance, earthquake insurance, home insurance, or boiler insurance. Risk of health. There is always a slight chance that someone dear to us might be at the mercy of a chronic condition which requires long-term care. What will happen if there's an emergency medical situation and you are not financially adept to meet your medical needs? Obviously, the last thing that you would want to do is wipe off all your savings to meet your medical needs. Fortunately, there is a health insurance. Health insurance ensures that undergoing long-term treatment does not throw a family into dire financial straits. By paying a small amount of premium to the insurer, you can take a cover under a comprehensive health insurance plan. This will shield your savings from sudden shocks of medical treatments. In this way, health insurance acts as a protective cover for both savings and health care so that you and your beloved family can continue to enjoy their life. Review questions. First, explain mortality risk and why there is a need of life insurance policy. Second question, explain the principle of life insurance policy. Third question, what are the benefits of life insurance policy? Question number 4, how we will determine the life insurance policy on the basis of your needs, of our needs. Fifth question, explain the difference between term life insurance and whole life insurance.